I need to warn you about something that could devastate your retirement income, something that most dividend investors are completely ignoring right now, something that has happened before and is about to happen again. I am talking about dividend cuts from companies that everyone assumes are safe, blue chip stocks that retirees depend on for income, names that have been paying dividends for decades, companies that your financial advisor probably told you were bulletproof. They are not bulletproof. And if you are holding these stocks expecting reliable income in 2026 and beyond, you need to hear what I am about to tell you. I have been managing money professionally for over 30 years. I have seen multiple dividend disasters unfold. I watched General Electric cut their dividend by 92% in 2017, after decades of being considered one of the safest dividend stocks in America. I watched AT&T slash their dividend by nearly 50% in 2022, after 35 consecutive years of increases. I watched Walgreens cut their dividend by nearly 50% in 2024, shocking income investors who thought pharmacies were recession proof. These were not small, speculative companies. These were blue chips, dividend aristocrats, the supposed bedrock of retirement portfolios, and they all cut their dividends when investors least expected it. Here is what I have learned from studying these situations. Dividend cuts never come out of nowhere. There are always warning signs months or even years in advance. The problem is that most investors do not know what to look for. They see a high dividend yield and assume it is a gift. They see decades of dividend history and assume it will continue forever. They do not dig into the financial statements. They do not analyze the payout ratios. They do not understand how business model disruption can turn a reliable dividend payer into a dividend cutter almost overnight. Today, I am going to share 4 blue chip stocks that I believe are at serious risk of cutting their dividends in 2020. 6. These are not predictions I make lightly. I have analyzed the financial statements, studied the competitive dynamics, and identified the warning signs that history has taught me to recognize. If you own any of these stocks for income, you need to pay very close attention. And even if you do not own them, understanding why these dividends are at risk will make you a better dividend investor for the rest of your life. Before I reveal the 4 stocks, let me explain the framework I use to identify dividend cuts before they happen. There are 5 warning signs that almost always precede a major dividend reduction. The first warning sign is a payout ratio that exceeds 100% of free cash flow. The payout ratio tells you what percentage of earnings or cash flow is being paid out as dividends. If a company is paying out more than it earns, it is essentially borrowing money or depleting cash reserves to maintain the dividend. This is not sustainable. A company can do this for a quarter or two during a temporary downturn. But if the payout ratio stays above 100% for an extended period, a dividend cut becomes mathematically inevitable. The company simply cannot keep paying out more than it generates forever. The second warning sign is rising debt levels combined with a high dividend payout. When a company takes on debt to fund operations or growth, that debt comes with interest payments. Those interest payments reduce the cash available for dividends. If debt keeps rising while business performance stagnates, eventually the company faces a choice: cut the dividend or risk financial distress. Management almost always chooses to cut the dividend rather than let the company go bankrupt, but they usually wait until the last possible moment, which is why the cut feels sudden to investors who are not paying attention to the balance sheet. The third warning sign is secular business decline. This is when the fundamental industry or business model is being disrupted by technology, competition, or changing consumer behavior. Companies facing secular decline often try to maintain their dividends as long as possible because cutting the dividend would signal to the market that management has given up on the turnaround, but you cannot indefinitely pay dividends from a shrinking business. Eventually, reality catches up. The companies that cut dividends most severely are usually those facing permanent structural decline, not temporary cyclical weakness. The fourth warning sign is management changing their tone about capital allocation. When executives start talking about needing to invest more in the business, or needing more financial flexibility, or reviewing their capital allocation priorities, those are code words for potential dividend cuts. Management knows that explicitly warning about a dividend cut would tank the stock immediately, so they speak in euphemisms. They prepare the market gradually. If you hear management suddenly emphasizing investment needs over shareholder returns, be very careful. The fifth warning sign is analyst estimates for earnings or cash flow that keep getting revised downward. Wall Street analysts are not always right, but they have access to management and industry information that average investors do not. When estimates keep coming down quarter after quarter, it suggests that the business is deteriorating in ways that may not be obvious from the headline numbers. Falling estimates mean falling cash flow, and falling cash flow eventually means falling dividends. Now, let me tell you about the first blue chip stock that I believe is at serious risk of cutting its dividend in 2020. 6. I am talking about Intel Corporation. Intel has been paying dividends for over 30 years. The company was once the undisputed king of semiconductors. Every computer had Intel inside. The dividend seemed as safe as any dividend could be, but Intel is now facing an existential crisis, and the dividend is very much at risk. Let me take you back to understand how Intel got into this position, because understanding the history helps you see why the future looks so challenging. In the 1990s and 2000s, Intel was one of the most dominant technology companies in the world. They had a near monopoly on processors for personal computers. Their manufacturing technology was years ahead of everyone else. They could charge premium prices because no one could match their performance. The profits were enormous and the dividend was covered many times over. But dominance creates complacency. Intel started making strategic mistakes that would compound over years. When smartphones emerged as the next major computing platform, Intel had a chance to compete but chose to prioritize higher-margin PC processors instead. They essentially handed the mobile market to ARM-based chip designers. That decision alone cost Intel trillions of dollars in market opportunity. Then Intel started falling behind on manufacturing technology. For decades, Intel had been the leader in chip fabrication, able to produce transistors smaller and more efficiently than anyone else. But somewhere around the 14-nanometer and 10-nanometer nodes, Intel stumbled. They had repeated delays, quality problems, and execution failures. Meanwhile, Taiwan Semiconductor Manufacturing Company kept advancing and eventually surpassed Intel in manufacturing capability. Today, TSMC manufactures chips for Apple, AMD, NVIDIA, and most other leading technology companies. Intel went from being the clear leader to being years behind. Let me explain what has happened to Intel. For decades, Intel dominated the market for computer processors through a combination of superior manufacturing technology and strong brand recognition. They could charge premium prices because they made the fastest chips. They had fat profit margins. They generated enormous free cash flow. The dividend was easily covered many times over. But Intel got complacent. They missed the shift to mobile computing. They lost their manufacturing lead to Taiwan Semiconductor. They failed to capitalize on the artificial intelligence revolution. Today, Intel is bleeding market share in every segment that matters. In data center processors, they are losing to AMD and increasingly to custom chips, designed by companies like Amazon, Google, and Microsoft. In personal computers, AMD has become a formidable competitor with chips that match or exceed Intel's performance at lower prices. In mobile, Intel is essentially irrelevant. And in AI accelerators, NVIDIA has run away with the market while Intel's offerings lag far behind. The financial results tell the story. Intel's revenue has declined significantly from its peak. Profit margins have collapsed. The company is spending tens of billions of dollars trying to rebuild its manufacturing capabilities, but the returns on that investment are years away and far from guaranteed. Meanwhile, the dividend keeps consuming cash that Intel desperately needs for its turnaround efforts. Look at the payout ratio. Intel's free cash flow has turned negative in recent periods as capital expenditures consume more than the company generates from operations. When free cash flow is negative, the payout ratio is technically infinite. The company is not paying dividends from cash generation. It is paying dividends from cash reserves and borrowing. This is not sustainable. Intel has already cut its dividend once, reducing it by 66% in 2020. 3. Many investors assumed that cut was enough to stabilize the dividend at a sustainable level. I am not so sure. The competitive situation continues to deteriorate. The manufacturing investments continue to consume cash. The turnaround keeps getting pushed further into the future if Intel's business does not improve significantly in 2020. 5. I believe another dividend cut in 2026 is very possible. Management may decide that every dollar going to dividends is a dollar not going toward the investments needed to save the company. Income investors who hold Intel for its current yield need to understand the risk they are taking. That yield looks attractive right now, but a high yield on a deteriorating business is often a trap. The yield is high because the stock price has fallen in anticipation of more bad news. If the dividend gets cut again, the stock will fall further, and you will have less income and a capital loss. There are much safer places to find dividend income. The second blue chip stock at serious risk of a dividend cut is Verizon Communications. Now I know this will be controversial. Verizon is one of the most widely held dividend stocks among retirees. The yield is attractive, typically around 6 to 7%. The company has raised its dividend for nearly 20 consecutive years. It seems like the epitome of a stable, reliable income stock. But there are serious warning signs that income investors are ignoring. I remember when telecom stocks were considered the ultimate safe havens for income investors. AT&T, Verizon, and the baby bells were the bedrock of retirement portfolios. People believed that everyone needs phone service, so these companies would always make money. That thesis seemed bulletproof for a long time, but the world has changed in ways that challenge that comfortable assumption. Let me explain the challenges Verizon faces. The wireless industry has matured. Nearly everyone who wants a cell phone already has one. Market penetration in the United States is essentially 100%. There are no new customers to acquire. Growth now comes from stealing customers from competitors, which requires expensive promotions, subsidized phones, and price competition. This is not a recipe for expanding profit margins. In fact, margins across the wireless industry have been under pressure for years, as carriers compete intensely for a fixed pool of customers. Think about your own experience as a wireless customer. When was the last time your bill went up significantly? Probably not recently. But when was the last time a carrier tried to win your business with a discount, a free phone, or a promotional rate? Probably quite recently. This competitive dynamic is brutal for margins. The carriers cannot raise prices because customers will switch, but they have to keep spending on network improvements, on customer acquisition, and on marketing. The profit squeeze is relentless. Verizon's revenue growth has been essentially flat. The company cannot grow its way to a better financial position. They are running in place, generating just enough cash to cover dividends, interest payments, and necessary capital investments. There is almost no margin for error. And here is the critical problem. Verizon is drowning in debt. The company has over $150 billion in total debt. This debt came from acquisitions, spectrum purchases, and network investments over the years. When interest rates were near zero, servicing this debt was manageable. But interest rates have risen dramatically, and Verizon's interest expense has ballooned. Every additional dollar paid in interest is a dollar not available for dividends. Look at Verizon's free cash flow and compare it to their dividend payments and debt obligations. The coverage is razor thin. In some quarters, free cash flow barely covers the dividend with almost nothing left over for debt reduction. Any decline in business performance, any unexpected expense, any need to increase capital investment for 5G or future technologies, and the dividend could become unsustainable. The pay-to-tail ratio based on free cash flow has been hovering near or above 100%. This tells you that Verizon is paying out essentially all of its free cash flow as dividends, leaving nothing for debt reduction, acquisitions, or a financial cushion. A company in this position has very little flexibility. One bad quarter, one competitive setback, one unexpected expense, and suddenly, the dividend is in jeopardy. There is another factor that worries me about Verizon. The fixed wireless and fiber businesses that were supposed to drive growth are facing increasing competition. Cable companies are pushing into wireless. T-Mobile is aggressively taking market share. Smaller competitors are nibbling at the edges. Verizon's competitive moat, which once seemed formidable, is narrowing. When competitive moats narrow, pricing power erodes, and profit margins compress. I am not saying Verizon will definitely cut its dividend in 2026, but I am saying the risk is much higher than most income investors appreciate. The combination of minimal revenue growth, massive debt, rising interest rates, intense competition, and a payout ratio near 100% is a dangerous cocktail. If any of these factors worsen, dividend investors could be in for an unpleasant surprise. The third blue chip stock I am worried about is Walgreens Boots Alliance. Now, Walgreens already cut its dividend dramatically in 2024, reducing it by nearly 50%. Many investors might think the hard work is done and the remaining dividend is safe. I am not so confident. In fact, I think the first cut may have been just the beginning. I have studied numerous dividend cuts over my career, and there is a pattern that repeats itself. Companies rarely cut once and stabilize. The first cut is usually management finally acknowledging a problem they have been denying for years. But by the time they acknowledge it, the problem has usually grown worse than they initially admit. So the first cut is often followed by a second cut, and sometimes a third. Investors who bought after the first cut, thinking they were getting a bargain yield, end up getting hurt again. Let me explain why Walgreens remains in serious trouble. The pharmacy business model is under assault from multiple directions. This is not a company facing one manageable challenge. This is a company facing existential pressure on virtually every front. Amazon is expanding aggressively into pharmacy, offering convenience and competitive pricing that Walgreens cannot match. Amazon Pharmacy delivers medications to your door, often with significant discounts for Prime members. For a generation of consumers who already buy everything from Amazon, ordering prescriptions online is a natural extension. Walgreens requires you to drive to a store, wait in line, and interact with humans. For many customers, especially younger ones, that experience feels increasingly outdated. Pharmacy benefit managers continue to squeeze reimbursement rates, making each prescription filled less profitable. These middlemen negotiate drug prices on behalf of insurance companies and employers. They have enormous power to dictate what pharmacies get paid, and they use that power to push reimbursement rates lower and lower. Walgreens can fill more prescriptions and still see pharmacy profits decline, because each prescription generates less margin the front of store retail business faces. Competition from dollar stores, convenience stores, and online retailers. And the healthcare services segment that was supposed to be Walgreens' future has struggled to gain traction. Walgreens has been closing stores at an alarming rate. They announced plans to close over 1,000 locations because so many stores had become unprofitable. Store closures mean less revenue, less cash flow, and less ability to cover fixed costs like debt payments and dividends. This is not a company investing for growth. This is a company in managed decline trying to shrink to profitability. The debt situation is concerning. Walgreens has significant debt obligations that require ongoing service payments. Interest expense competes with dividends for available cash flow. When a company is shrinking, debt becomes more burdensome, not less. The same debt that seemed manageable when the company was growing becomes crushing when the company is contracting. Look at Walgreens' recent financial results. Revenue is declining. Same-store sales are weak. Profit margins are compressed. Cash flow is stressed. The company has been selling assets to raise cash, including portions of its stake in drug distributor Cencora. Asset sales can provide temporary relief, but they are not a long-term solution. You can only sell assets once. When the assets are gone, the cash flow problems remain. The first dividend cut shocked many income investors who viewed pharmacies as essential businesses that would always generate stable cash flows. But essential does not mean profitable. And stable does not mean growing. Walgreens may be essential to communities, but that has not prevented the business from deteriorating. If the deterioration continues through 2025, another dividend cut in 2026 becomes a real possibility. I particularly worry about the healthcare services strategy. Walgreens has invested heavily in primary care clinics, hoping to transform pharmacies into healthcare destinations. But building a healthcare business is expensive, complicated, and slow. The investments consume cash for years before generating returns, if they ever do. If the healthcare strategy fails to produce results, Walgreens may need to cut the dividend further to conserve cash. Income investors need to ask themselves a hard question. Do you own Walgreens because it is a great business with a bright future? Or do you own it because the yield is high and you are hoping the dividend survives? Hope is not an investment strategy. If you cannot make a compelling case that Walgreens' business is improving, you should consider whether there are better places for your income-oriented capital. The fourth blue-chip stock I believe is at risk of a dividend cut is 3M Company. 3M is a legendary American corporation with over a century of history. The company has paid dividends for more than 100 years and increased the dividend for over 60 consecutive years. That makes 3M a dividend king, an elite status reserved for companies with the longest track records of dividend growth. But even kings can fall, and 3M faces challenges that threaten its royal dividend status. I want to tell you a story about dividend aristocrats and dividend kings because it illustrates an important point. These designations sound impressive. 60 consecutive years of dividend increases. It feels like a guarantee of safety, but it is not a guarantee. It is simply a record of the past, and the past does not obligate the future. General Electric was once considered one of the safest dividend stocks in America. They paid dividends continuously for over 100 years. Then they cut the dividend to a penny per share. AT&T was a dividend aristocrat for 35 consecutive years of increases. Then they slashed the dividend by nearly half. The history of supposed dividend safety is littered with fallen aristocrats and dethroned kings. Let me explain what is happening at 3M. The company is dealing with massive legal liabilities related to two major issues that could consume billions of dollars in cash over the coming years. The first is PFAS contamination, often called forever chemicals, which have polluted water supplies across the country. These chemicals were used in everything from firefighting foam to non-stick cookware. They do not break down naturally in the environment, which is why they are called forever chemicals. They have contaminated drinking water for millions of Americans and have been linked to various health problems. The first is PFAS contamination, often called forever chemicals, which have polluted water supplies across the country. 3M manufactured PFAS chemicals for decades and now faces billions of dollars in potential liabilities for cleanup costs and health. Related claims: the company has agreed to settlements totaling over $10 billion, but the total ultimate cost remains uncertain. Additional lawsuits keep getting filed. The legal exposure could grow significantly larger than current estimates. The second legal issue involves military earplugs that allegedly failed to protect service members from hearing damage. 3M's Combat Arms subsidiary made earplugs used by the military, and hundreds of thousands of veterans have filed claims alleging that defective earplugs caused hearing loss and tinnitus. 3M attempted to resolve this through bankruptcy of the subsidiary, but courts rejected that strategy. The company now faces ongoing litigation with potential liabilities that could reach additional billions of dollars. These legal liabilities are not theoretical risks. They are real cash obligations that 3M must fund. Every dollar paid to settle lawsuits is a dollar not available for dividends. Debt reduction or business investment. The company has already taken massive charges against earnings to reserve for these liabilities. But if the actual costs exceed the reserves, more charges and more cash outlays will follow. Beyond the legal issues, 3M's underlying business has been struggling. The company spun off its healthcare business, which was one of the stronger performing segments. What remains is a portfolio of industrial and consumer products that face intense competition and margin pressure. Revenue has been declining, earnings have been falling. The company has announced layoffs and restructuring efforts to cut costs. But cost cuts cannot fully offset revenue declines forever. The payout ratio at 3M has been elevated as earnings have fallen while the dividend stayed constant or grew modestly. The company has been paying out a higher and higher percentage of declining profits. This is not sustainable indefinitely. At some point, either earnings need to recover or the dividend needs to come down. Management has publicly committed to the dividend, as management of distressed dividend stocks always do until suddenly they do not. But actions speak louder than words. Watch what 3M does with its capital allocation. If they need to prioritize legal settlements and business investments over shareholder returns, the dividend could be reduced. The 60-plus year streak of dividend increases may come to an end. 3M shareholders need to understand that they own a company facing existential legal threats combined with a deteriorating core business. The dividend aristocrat status provides psychological comfort but no legal protection against dividend cuts. If management decides that preserving the company is more important than preserving the dividend streak, they will cut the dividend. History shows that companies facing this choice almost always prioritize survival. Now let me bring this together and explain how you should think about dividend safety in your own portfolio. The 4 stocks I have discussed, Intel, Verizon, Walgreens, and 3M, share common characteristics that income investors should learn to recognize and avoid. First, each of these companies faces fundamental business challenges that are not easily fixed. Intel is trying to rebuild its competitive position in semiconductors after falling behind. Verizon is trying to grow in a mature, competitive market while servicing massive debt. Walgreens is trying to transform its business model while core pharmacy economics deteriorate. 3M is trying to resolve enormous legal liabilities while its industrial businesses shrink. These are not cyclical challenges that will resolve when the economy improves. These are structural challenges that require fundamental business transformation. Second, each of these companies has a payout ratio that leaves little margin for error. When a company pays out nearly all of its cash flow as dividends, there is no cushion for unexpected problems. Any setback immediately threatens the dividend because there is no reserve to draw from. Conservative dividend investors should look for payout ratios well below 100%, ideally in the 50 to 70% range. This provides a buffer that can absorb temporary business disruptions without endangering the dividend. Third, each of these companies has significant debt that competes with dividends for available cash. High debt levels are manageable when business is strong and interest rates are low. But when business weakens or interest rates rise, debt service consumes an ever larger share of cash flow. Income investors should be wary of companies with high debt levels and limited revenue growth, because those companies have the least flexibility to maintain dividends through difficult periods. Fourth, each of these companies has a dividend yield that looks attractive precisely because the stock price has fallen. High yields can be genuine opportunities, but they can also be traps. The market is not stupid. When a stock yields significantly more than similar companies, there is usually a reason. That reason is often that the market expects the dividend to be cut. Before chasing a high yield, ask yourself why the yield is so high. If the answer involves deteriorating business fundamentals, be very careful. Let me tell you what I look for in a truly safe dividend stock. I want a company with a growing business, not just a stable business. Growth provides the rising cash flows needed to increase dividends over time and to survive unexpected challenges. I want a payout ratio well below 100%, leaving room for dividend increases and a buffer against business volatility. I want a strong balance sheet with manageable debt, so that interest payments do not compete with dividends for cash. I want a competitive moat that protects profit margins from erosion, and I want a management team with a track record of smart capital allocation and shareholder-friendly behavior. Companies that meet these criteria include names like Johnson & Johnson, Procter & Gamble, Coca-Cola, PepsiCo, and Microsoft. These companies have been raising dividends for decades. But more importantly, they have the business quality and financial strength to continue raising dividends for decades more. Their yields may be lower than the stocks I warned you about today, but the income is far more reliable. Here is the uncomfortable truth about dividend investing. You cannot have both maximum yield and maximum safety. High yields usually indicate high risk. The companies paying the highest dividends relative to their stock prices are almost always facing challenges that make those dividends unsustainable. If you chase yield without regard for business quality, you will eventually experience dividend cuts that more than offset the extra income you collected along the way. I have seen this pattern destroy retirement portfolios. An investor retires with a portfolio of high-yielding stocks, planning to live on the dividend income. The income looks sufficient initially, but then one company cuts its dividend, then another, then another. Within a few years, the dividend income has fallen dramatically, and the portfolio value has dropped as well, because dividend cuts usually accompany stock price declines. The retiree is left with less income and less capital, precisely the opposite of what they planned. The better approach is to build a portfolio of high-quality dividend stocks with moderate yields but strong dividend growth. A stock yielding 3% today that grows its dividend by 8% annually will yield more on your original investment in 10 years than a stock yielding 6% today that cannot grow its dividend at all. And the growing dividend stock will likely appreciate in value as well, giving you both higher income and capital gains. If you own any of the 4 stocks I discussed today for income purposes, I strongly encourage you to reassess your position, understand the risks you are taking, understand that a high yield today does not guarantee a high yield tomorrow. Consider whether there are better alternatives for your income needs, and remember that protecting your principal is just as important as generating current income. I want to be clear that I could be wrong about any or all of these specific companies. Perhaps Intel's turnaround will succeed faster than expected. Perhaps Verizon will find new growth engines. Perhaps Walgreens will successfully pivot to healthcare services. Perhaps 3M will resolve its legal issues for less than feared. The future is inherently uncertain, and even the most careful analysis can prove incorrect. But the warning signs are real. The risks are substantial, and the potential for dividend cuts is higher than most income investors appreciate. My goal is not to tell you exactly what will happen. My goal is to help you see risks that you might not have recognized and to encourage you to think more critically about the dividend stocks in your portfolio. Dividend investing done right can be a wonderful strategy for building wealth and generating retirement income, but dividend investing done poorly, chasing yield without regard for business quality, can be financially devastating. The 4 stocks I discussed today represent dividend traps that could hurt unwary investors. Learn to recognize the warning signs, demand business quality, not just high yields, and build a dividend portfolio that can weather whatever challenges lie ahead. Let me share one more story that illustrates why this matters so much. I once met a retiree who had built what he thought was the perfect income portfolio. He had concentrated his savings in a handful of high-yield stocks, all well, known names that had paid dividends for decades. His yield was over 6%, and he calculated that he could live comfortably on the income without ever touching principal. It seemed like a bulletproof plan. Within 3 years, 2 of his largest holdings had cut their dividends significantly. His income dropped by more than 30%. The stocks themselves had fallen even more, so his principal had declined substantially as well. He was left with less income, less capital, and fewer options than he had started with. The dream of living comfortably off dividends had turned into a financial nightmare. This story repeats itself constantly among income investors who prioritize yield over quality. They see a 6% yield and do not ask why the yield is so high. They see decades of dividend history and assume it guarantees future payments. They do not analyze balance sheets, competitive positions, or payout sustainability, and then they are shocked when the dividend gets cut. But they did not want that to happen to you. The 4 stocks I discussed today, Intel, Verizon, Walgreens, and 3M, all have characteristics that historically precede dividend cuts: high payout ratios, business model challenges, Heavy debt loads, competitive pressures, uncertain futures. Some of them may prove me wrong and maintain their dividends, but the risks are real, and income investors should not ignore them. The income you depend on in retirement is too important to leave to chance. Take the time to analyze your holdings. Understand the businesses behind the dividends, and make sure you are not holding stocks that could deliver unpleasant surprises in 2026 or beyond. Your financial future depends on getting this right. Do not be the retiree who learns these lessons the hard way. Learn them now while you still have time to protect yourself.